Good morning, everyone. Hope you're all healthy, happy, and getting ready to vote today on this very important day. So we are continuing today with the accounts receivable. Okay, we are dealing with Chapter 7. What I wanted to mention to you again before we begin is that we are going to be having our quiz on Chapter 13. Okay, so just so that everybody is up to date, we will be having our quiz, and that is going to be on Chapter 13. Okay, and it is going to be held on November 20th. Okay, and again, just like previously, it's going to be held during the first half hour of class. Okay, and then the score again that you get on that quiz can give you up to 10 additional points on your next midterm grade. Okay, and then what I want you also a little bit. Oh, I'm sorry, it's supposed to be 2020. Okay, let me erase that. All right, so the quiz, you're taking away my thunder, Joshua, thank you. All right, so the quiz is going to be on 11:10. Okay. And it's going to be on Chapter 13. Okay, now the new thing that I want to mention to you is that since we are moving ahead very well, okay, this semester with in terms of timing, okay, what I want you to put in your books of records is that we are going to be having our second midterm. Okay, we are going to be having our second midterm on 11/19. Okay, we're going to be having it before the Thanksgiving break. Okay, so 11/19 is a Thursday. Remember, you must take the midterm before on that day, unless you have a doctor's note or some type of verification that you were unable to take the exam. And again, the midterm exam will pick up where we left off last time. Okay, and then it'll go through the chapter. Most likely, it'll include at least Chapter 16. Okay, and then as we get closer to that date, you will know specifically which chapters are going to be on it. Okay, again, the midterm exam is going to be 30 multiple choice questions. Then we have about a month left. And again, we have a holiday in there. So then we have about a month left before we have the final exam. Okay, so we're moving right along. Our Apple investment as of Tuesday, again, the markets have been because of Election Day, because of all the instability that's going on. Our Apple investment on Tuesday was selling at about $113.68 per share. Okay, and then somebody could check for me what it's selling at. Oh, $113. $113. Sorry. If somebody could check what price it is selling at right now, because I don't have my phone with me. I forgot it. So if somebody could just let me know what the current 110. All right. Thank you, Kareem. So now Apple is selling at approximately, and again, that's due to the instability in our government right now. You know, it's a very contentious election day. Okay, so a lot of there's instability. Again, people are very nervous about the coronavirus. Okay, they're anticipating there's going to be another surge in coronavirus cases. Again, that's why you want to make sure you take care of yourselves. Wash your hands, okay? Make sure you avoid public places. All right, you don't want to be laid up with something like this, at this stage or really during any stage of your life, but right now especially, okay? So make sure you take care of yourselves. All right, so that is the situation now, okay? Again, dealing with a lot of instability, but again, it is the best time now to invest in yourselves. You know that next semester is going to be online as well. Okay, so make sure that you take the time, okay, and you are up and running when this dreaded pandemic is finally over. Okay, Joshua, is the format of the next quiz going to be the same with format and timing? Yes. Now, Chapter 13 is a little different because of the fact that it's the statement of cash flows, I'm sure you remember, and there's the 3 different sections. So, but it will be the same format. Again, it's going to be calculations primarily. Okay, and then, but in a multiple choice format. So you'll have certain options as to what the answers could be. And of course, most likely, I'll be asking you to unaccrue certain accounts in any of those 3 different sections of the statement of cash flows. And it will be 30 minutes as well. The quiz is multiple choice, but it's multiple choice calculations. Okay, so it's not going to be theory questions for the midterm exam, for the quiz. On the midterm exam, yes, there will be theory. And the midterm will be the same way. It'll be 30 multiple choice questions. Some are going to be calculations. Some are going to be theory. Okay? All right, so what were we dealing with last class? Last class, we were dealing with accounts receivable. Okay, remember accounts receivable, especially because we're an economy that basically purchases a large amount of their goods on credit. Okay, accounts receivable is a very important account that appears on the balance sheet. Okay, remember accounts receivable is a current asset. Okay, and it sits below, right below, typically the cash is the first asset account, and beneath that you'll have available for sale marketable securities, if that's something the corporation owns, and then you'll have inventory directly below, and I'm sorry, then you'll have accounts receivable directly below that. Okay, and again, what are accounts receivable? When the corporation makes sales on account, okay, and give their customers credit, and they basically are giving their customers anywhere from 30 to 60 days to pay back, to pay them the funds that they require for their purchases. Okay. All right. All right. So I know we started this. Receivables, you could, in terms of internal controls, again, they're built into the corporation. A corporation doesn't want to ever extend credit to a customer who might not be able to pay them. Okay. But again, it is in the normal cost of business. Okay. It is a normal business expense. It is a normal business expense that some of the accounts receivable are ultimately going to be uncollectible. Okay, uncollectible account expense. Okay, even in the best of situations, okay, some of your customers, at least in the short term, may not be able to pay you. Okay, when you're selling goods on credit. Okay, and again, only those businesses which deal exclusively with cash sales are really going to be not affected by this uncollectible account expense. Okay, but again, the majority of the businesses in the United States do business on credit. Okay, now the problem is, that let's say it's the first year of operations, and a corporation basically makes a sale in January. Okay, now again, the corporation is making the sale assuming that their customer is going to be able to pay them back the monies that they owe. Okay, so what can happen though, a certain length of time passes, and actually it's not until June, okay, 5 months later, all right, when the corporation, the selling corporation, finally gets notification from their customer that guess what, we're actually not going to be able to pay you. Okay, so again, there's a wait of 5 months, okay, but within GAAP, okay, remember one of those major principles that you learned in Accounting 101 is the matching principle. Okay, and remember the matching principle basically states, okay, that revenues and expenses, okay, have to be offset, okay, against each other, okay, in the same time period. So related revenues and expenses, okay, must be offset against each other during the same time period during which they are incurred. Revenues and expenses. Okay, so what is the problem here? We don't actually know the actual amount of bad debt expense or uncollectible account expense until June. Okay, but in order to be in compliance, okay, with the matching principle, all right, most corporations, if they do business on a credit basis, what they have to do is estimate. Okay, they must estimate the amount of uncollectible account expense. Okay, on an intermittent basis. And again, this is required, this is sanctioned by GAAP. All right, the corporation must do this. Okay, so how do they do that? Okay, again, remember, under GAAP, it always has to be consistent. Okay, the mannerisms that this is actually being done have to be applied equally among all the corporations who are affected by it. Okay, so what happens when a corporation is estimating the amount of uncollectible account expense? There are two different methodologies for estimating the amount of the bad debt. Okay, there is first, there is the income, the first is the balance sheet method. Okay, and that is the more popular method, the balance sheet method. And the same method, the other method is the income statement method. Okay, so a corporation, if it's doing a significant amount of their sales on a credit basis, okay, they have to select which methodology they're going to use, the balance sheet method or the income statement method for estimating the amount of their bad debt expense. Okay, and again, once a corporation selects a methodology, they must stick with this methodology to be consistent into the future. All right, so again, this is a little bit unusual. Okay, we never saw something like this where we're estimating basically an expense during the year to offset a major revenue account. Okay, but again, it is required by GAAP. All right, so let's take a real life example. Okay, so here to illustrate the matching process, let's say this toy company begins operations on January 1st, 2018. Okay, and it makes most of its sales on account. So at the end of the first month, okay, they see that their accounts receivable equal $250,000. Okay, so that's how much in accounts receivable, a current asset account, appears on their balance sheet. Okay, and again, the amount of bad debt expense has to be estimated on an intermittent basis. So again, typically that's going to be on a monthly basis. All right, so on this date, okay, and it's typically going to be somebody who has some expertise in this area. It's not going to be a clerk, right, in the accounts receivable area. It has to be somebody who has a little bit more training. Okay, so it would be, let's say, the credit manager. Okay, the credit manager looks at all outstanding debt, and that they believe that approximately $10,000 of this $250,000 in accounts receivable is ultimately going to be uncollectible. All right, so at the end of the month, okay, the journal entry that they're going to estimate the uncollectible accounts, and here, remember, they don't know specifically at this point which customer is going to call them and say, we can't pay. Okay, they're not aware of it. They're just making an analysis based on past experience, what the amount is that they believe will ultimately be uncollectible. Okay, so here they estimated about $10,000. So what is the journal entry whenever a corporation is estimating the amount of their bad debt expense. They're going to debit the uncollectible accounts expense. And again, this is offset, right, with the sales revenue for this time period. Okay, and then they're going to credit an account called the allowance for doubtful accounts. Okay, remember this allowance for doubtful accounts, it's similar to that depreciation, accumulated depreciation accounts. Okay, so again, it's going to appear, it is a balance sheet account. Okay, but this allowance for doubtful accounts appears directly below accounts receivable. And what is it going to do? It reduces the net realizable value. So since it reduces the net realizable value of the accounts receivable, it is considered a contra asset account. Okay, it reduces the amount of the related asset account, which is accounts receivable. Okay, and remember that means that the allowance for doubtful accounts always is going to appear with a credit balance. Okay, now question, would you consider this allowance for doubtful accounts? Is this a permanent account? Okay, which is going to appear on the balance sheet. Of course, the balance is going to change. Or is it a temporary account, which is going to be closed at the end of each year? What do you think? Temporary? Temporary. All right, so again, look at the journal entry. We're debiting uncollectible account expense, crediting the allowance account. Which account here is the temporary account? Uncollectible account expense. This allowance for doubtful accounts, remember, it's a contra asset account, just like the accumulated depreciation. Okay, so this allowance for doubtful accounts is a permanent account. Okay, it is going to be adjusted every year, okay, or every month. Okay, but it's going to it's always going to be an account that appears on the balance sheet. Okay, so this allowance for doubtful accounts is a permanent account. Okay, it's a permanent balance sheet account. The temporary part of it, of this journal entry, is the debit to uncollectible account expense. Is that clear? Does that make sense, guys? Okay, this is the adjusting journal entry, and again, this is a debit to the expense account. The expense account will be closed at year end. However, this allowance for doubtful accounts is a permanent account. It will always have a balance. Okay? All right, so make a little note of that. Contra asset, and it is a permanent account. All right, so now, very nice, we have $10,000 sitting in that allowance account. Yes, Lysander.
By uncollectible, you're not gonna pay it, or?
No, okay, remember, this uncollectible account expense, remember, what are you offsetting it against? You're matching the revenues of this time period, which is the sales, okay, and you're matching here the uncollectible account expense. You're matching the expense for those accounts that you're not going to be able to collect against the revenues during the same time period. Okay, so what this uncollectible account expense does, it reduces the amount of revenues that is going to be reported on the income statement. Okay, because the sales account, you know, that's a revenue account. It appears on the income statement, and then you have the uncollectible account expense, and then you have the allowance for doubtful accounts, which is the contra account that's going to appear on the balance sheet. So here you're matching sales revenue and the related expenses of bad debt or uncollectible account expense. Okay, good.
Yeah.
Okay. All right, good. So let's move on now. So now, and remember, this adjusting journal entry has to be made. It's an adjusting entry. It's going to be made at the end of every month. Okay, and it's going to be based. It's going to be based on an analysis that's done either using the balance sheet method for estimating bad debt or the income statement method. Okay. GAAP does not allow does not allow a corporation that does a significant amount of credit sales. It does not allow them just to recognize the bad debt when the customer calls you and says, I can't pay you. Okay, it is required according to GAAP that this adjusting journal entry is made to offset any bad debt expense against any sales that were made during that same time period. Okay, so this is a monthly adjusting entry that must be made. Okay. All right, so now let's move on. Okay, so now realize, why do you do this? Why do we do this journal entry? Okay, basically because of the fact that, all right, if we looked at our accounts receivable, okay, we know that during this month the accounts receivable was $250,000, right? For January, for this particular month, the amount of the accounts receivable were $250,000. Okay, now how much of the allowance for bad debt they report for this month? Remember, this is a contra asset account. All right, so how much was the allowance for bad debt that was established? $10,000. Okay, so based on the journal entry that we just prepared, okay, what is the net realizable value, guys? What is the net realizable value on the balance sheet, okay, at the end of January for this toy company? 240,000. Excellent, Daniel. Okay. All right, but now look what happens. Due to the fact that the corporation basically records the amount of this bad debt expense, this is the way that it's going to appear on the balance sheet. Okay, again, you always have cash, marketable securities. The third most important or most liquid account is going to be the accounts receivable. Okay, very important current asset account. Okay, so here it had an available balance at the end of January of $250,000. Now, again, remember, always put brackets around it so you don't forget. The allowance is going to be deducted. Okay, and now the net realizable value of accounts receivable equals $240,000. We don't know who the bad debt expense is going to basically come from. Again, we didn't make any sales on credit because we thought the customers were not credit worthy, but things happen. Okay, it's a normal business expense. Okay, but due to the fact that that journal entry was made, okay, due to the fact that that allowance account was set up, okay, once we get the call from the customer, okay, once the toy company gets the dreaded phone call from their customer saying, you know what, we can't pay you the $4,000 that we owe you. Okay, for some reason we're short on cash, whatever. So here in early February, when Discount Stores, one of Famous Toy Company's customers, okay, says, you know what, we're going out of business, all right, we can't pay you the $4,000 we owe you. Sorry, Charlie, okay, you're out of luck. Okay, this is going to be, again, when you set up the allowance account, the allowance for uncollectible account expense, when the customer calls you, okay, this is now the journal entry. And just please, on your slides, just correct this. This should be on February 5th. Okay, on February 5th, when you get that phone call, look what you're going to do. You're going to reverse, okay, $4,000 of that allowance that you established at the end of January. $4,000 of that allowance account is going to be debited here, okay? And your question is going to be, well, wait a minute, why are we reducing? Because remember, it had a credit balance. It's a contra asset account. Why am I debiting it on February 5th? And the answer is, now it's no longer a bad debt. Okay, but I know it's not allowance for doubtful accounts. I know this is actually a bad debt. Okay, this is an account that's not going to be collectible. So when the customer calls you, remember that reserve you set up, the allowance for doubtful accounts, you're going to debit that account. And then which account is going to be credited? You're going to credit that particular customer's accounts receivable. Okay, because again, it's not, there's not any doubt anymore as to who is not going to be able to pay you. You know which particular customer can't pay you. So this is the reserve that you set up. You're going to debit the reserve for the $4,000 in real bad debt now, and then you're going to credit the accounts receivable. And remember, you have to credit the accounts receivable, okay? But what does what does crediting this account receivable do, okay, to your balance sheet? When you credit an asset account of accounts receivable, what does it do to the balance on your current assets? Okay, excellent, guys. It reduces it. Remember, if the corporation, famous toy company, if they didn't reduce the amount of their accounts receivable, their assets would be overstated. Okay, so whenever they get the phone call, they know they know which specific customer is not going to be able to pay. So they're going to credit their accounts receivable, and then also what do they have to do? They're going to reduce the amount in their allowance account, okay, because they know it's not doubtful that this customer can't pay. You know they really cannot pay. All right, so this is all a journal entry. When you use the allowance method for bad debt, when you get the phone call from your customer, this is always the journal entry made. Okay, decrease the allowance for doubtful accounts. Also decrease the specific account receivable. Okay, and remember, okay, when was the actual expense? Okay, this is a good question. Okay, when was the actual expense for the bad debt recognized? Was it recognized in February when you're doing this journal entry, or was the actual estimated bad debt expense recorded in January? Okay. Kristen, you think in February? Okay, but when would, remember, when was the bad debt expense? Very good, Joshua. Or the bad debt expense was actually recorded in January because they're trying to match the revenues, remember, that were recorded in January, the accounts receivable recorded in January with the bad debt expense of January. Okay, so the expense part of this was estimated in January. Now in February, when you know which specific customer can't pay you, that's when now you're going to reduce the amount of the allowance. But the expense had already been recognized, okay, in the month of the sale. Okay, in the month that the accounts receivable was established. And that's really the whole reason that you set up the allowance account. Okay, because you're matching the revenues and the sales with the uncollectible account expense during the same month. Okay, Kristen, good? Okay, here again, now you're just reversing it. Okay, a very good question, hint, hint. Okay, so again, what does the fact that we made an estimate, okay, if we work for a famous toy company, what was the effect of them estimating the bad debt expense in the same month of the sale? Okay, so here in January, accounts receivable was $250,000. Here, the allowance for doubtful accounts, remember, always do the brackets just so you don't forget. That contra asset account, what is the net realizable value in January? Okay, because of the fact that the bad debt expense was estimated, the net realizable value of their accounts receivable was $240,000. Okay, because even at that point, Famous Toy Company did not believe they were going to receive the full $250,000 of their receivables. Okay, somebody was not going to be able to pay. Okay, now what happens in February, okay, after the write-off? In February, when they get the dreaded phone call from their customer that they are not going to, Discount Toys cannot pay them, okay, remember, accounts receivable was credited. Okay, so accounts receivable equals $246,000, okay, after the write-off. And then again, remember the allowance for doubtful accounts. What was the journal entry when we got the phone call from the customer? Remember, the allowance for doubtful accounts was debited. Okay, it was reduced by the $4,000 because it's no longer a doubtful account. We know this account is no good. Okay, so with the write-off in February, the allowance for doubtful accounts was reduced to $6,000. So what was the net realizable value, okay, of the accounts receivable? Again, in January and February, the net realizable value was the same. Okay, and again, why is that? Because we already estimated the amount of the bad debt expense. Okay, the estimated amount of the bad debt expense was already made in January. Okay, because of the matching principle. So when you finally get the phone call from the customer saying, I'm not going to be able to pay you the accounts receivable that I owe you, or you already built in that cushion. Famous Toy Company already built in that cushion of the $10,000 of uncollectible account expense. Okay, so when you got the dreaded phone call, you already had a little fund established for that, knowing that some of your debt was going to be uncollectible. And this is exactly why you set up, you do the journal entry, the adjusting journal entry at the end of every month. Okay, because you're estimating during the month of the sale, you're estimating the amount of uncollectible account expense. Okay, so that when it actually comes true, you already have a reserve established. Okay, everybody's good? Okay, so again, and Denise, will that always be the case when the net realizable value doesn't change after the write-off? Yes. Okay, and that's always because, excellent question, Denise, and that's because of the fact that you estimated the amount of the bad debt. Okay, the only and good point. The only time, Denise, where the net realizable value would be different is if you really underestimated. Let's say in like a pandemic like this. Okay, let's say you believed going in at the end of last month that you were only going to have $10,000 of uncollectible accounts. But because of this pandemic, the actual amount of doubtful account, actual amount of bad debt expense is greater than the fund that than the amount that you established. Only in that instance would there be a difference. Okay. All right, but good question. But again, it's in normal circumstances, that would always be the case. The net realizable value wouldn't change because you put in an educated estimate as to what that allowance would be. Good question. Okay. All right, so let's move forward. So as we were just talking, okay, basically the credit manager or somebody who has expertise in the area of accounts receivable, credit sales, etc., at the end of every month, a responsible party must estimate, okay, the amount of uncollectible account expense for the month. And remember, this is always going to be based on the credit sales for the particular month, right? All right, so there are two ways that to estimate the credit losses. Okay, two ways to basically estimate the balance at the end of every month for the uncollectible account expense. Because remember, you're going to have credit sales. Typically, a business is going to have credit sales occurring every single month. Okay, so the first question is, okay, does this company use the balance sheet method or does it use the income statement method? Okay, and you can always tell based on which financial statement they are relying on to make the calculation. Okay, the balance sheet method is considered the more accurate method. Okay, the balance sheet method is considered the more accurate method, and we'll take a look at why that is in a moment. Okay, but even though the balance sheet method is more accurate, corporations are also allowed to use the income statement approach, whichever one they want. Okay, but again, they have to apply it consistently. Okay, all right, and now the nice thing, okay, the nice thing about these two approaches is for the most part, you're going to be given all of the information. Okay, but you have to remember, okay, balance sheet method means I have to look at a balance sheet account, which is going to be the accounts receivable. For the income statement method, okay, that means I have to look at an account that appears on the income statement. That's going to be net credit sales. Okay. All right, so now forget about anything the income statement approach. Here we're discussing the balance sheet method only. Okay, again, the balance sheet method for, and again, this is for estimating bad debt. Okay, the balance sheet method for estimating bad debt is the more widely used methodology. Okay, and again, what are we doing here? We're looking at a balance sheet account. Okay, so what happens here? And again, you're going to be provided all the detail behind this. That's the nice thing. You just have to know what to do with the information. So what basically happens under the balance sheet approach is that the accounts receivable is going to be aged. Okay? All right, so under the balance sheet methodology, the corporation has to perform an aging of accounts receivable. Okay, and what does that mean when you age an accounts receivable? Okay, so let me ask you a question. Let's say you lend a friend money. Okay, you lend a friend $100, and your friend tells you, I'm going to pay you back that $100 next month. Okay, what happens to the likelihood that that person is going to pay you back the money, okay, the longer that debt is outstanding? Okay, so you lend your friend $100 this month. They're supposed to pay you back next month. Exactly, okay? The longer that a debt is outstanding, okay, the longer an account is past due, the greater the likelihood that it's not going to be collected in full. Okay, that's just human nature. Okay, so that's why, again, if you lend your friend money, or if you're a business and you extend credit, again, you don't want to wait till they're past due to start sending notices and making them aware, okay, of the fact that they owe you money. You want to be very proactive with this. Okay, but it's a known attribute that the longer an account is outstanding, the less likely it's going to be collected. So what the manager is going to do using the balance sheet approach, at the end of every month, they're going to come up, okay, with an aging of the accounts and the related dollar value, okay, based on their past experiences. Okay, so what will that look like? You will see a chart like this. Okay, and again, typically your general ledger software will be able to give this information to you. Okay, so that's why most companies, again, it's considered the more accurate approach. Okay, but and most companies use it. Look what they've done here. Okay, based on every level, okay, as to the aging of the accounts. So the first line, the amount, there's some accounts, and again, this is aging of the accounts receivable. Okay, there are some accounts receivable, okay, that are outstanding that are not yet due. Okay, so here, if we looked at this corporation, Valley Ranch Supply, on their balance sheet, we would see that they have a total accounts receivable of $100,000. Okay, then again, what would the credit manager do? They would say, okay, we know that about $51,000, okay, of these accounts receivables are not due yet. Okay, they're not due until the next month. Okay, so historically, what has been our corporation's experience as to what percentage of the debt, okay, which is outstanding but still not due? What's historically the amount that we have found this is going to be uncollectible? Okay, based on our own past history, approximately 1% of the current accounts receivable are going to be uncollectible. Okay, so what are you going to do? You're going to multiply the dollar value in that age group, okay, times the percentage, times 0.01, okay, to come with the amount that is going to be added to that pool of uncollectible account expense for the current month. Okay, so from this tier, the $51,000 out of the total of $100,000, approximately, we believe about 1% is going to be uncollected from that tier. So we're going to do the calculation. All you have to do is just multiply the dollar value in that age group times the probability that it's not going to be collected, okay, to come up with a dollar value of your estimate. Okay, and again, this is going to be done for the entire balance of the accounts receivable. All right, but again, remember, you'd have to be provided this information. There's no way you could get a gut feeling for this. So maybe I give you everything except here, this estimated, I will give you all the information except for the estimated uncollectible accounts. And all you have to do, remember to do, is to multiply across the dollar value times the probability, and that will give you the amount of uncollectible accounts estimated for that tier. Okay? And again, your general ledger software would usually provide you with this information. So what's the next tier? Okay, the next layer of aging in the accounts receivable schedule, approximately $29,000, okay, of the accounts receivable have been out, basically are past due between 1 and 30 days. So these are already past due. Okay, so you're gonna know intuitively the possibility that you're not going to receive payment for those accounts receivable, okay, that are already overdue from 1 to 30 days. It's going to be greater than 1%, okay, because of the fact they're already overdue. Okay, they're high risk, they're at a little bit of a higher risk of being unpaid. So now what do? Take the $29,000 in that tier, multiply it by the probability, again, 0.03, right? These are all percentages. Okay, so the number of dollars contributed to the uncollectible accounts is $870. Okay, then you go to the next layer, 31 to 60 days past due. Okay, again, you've gotten from your records that approximately $12,000 of accounts receivable fall within this age group, 31 to 60 days past due. And there's a 10% liability that these are going to be uncollectible. Okay, so the $12,000 times the 10%, again, this layer is contributing $12,000 to your allowance account for this month. And again, does this make sense? Take a step back. Does it make sense that the longer that an account receivable is outstanding, the greater the likelihood that it's going to be unpaid? Okay, does that make sense logically? Yes, absolutely, Shamaya. Very good. Okay, it makes sense. Okay, so here again, we do the same thing for 61 to 90 days past due, and then for 90 days past due. So look what happens. Okay, for those accounts receivable that have been outstanding for greater than 90 days, there's only a 50-50 chance that they're going to be uncollectible. Okay, there's only 50-50 chance they're going to be collectible also. Okay, so that's why a corporation really has to make sure that there are procedures in place to monitor these accounts receivable and collect them are very strong. Look at the difference. It goes from 1%, okay, to 50% in 90 days. Okay, so that's significant. All right, and again, these percentages are estimated every month by the credit manager. All right, so what happens is that at the end of the current month, at the end of December, this credit manager believes that out of the total $100,000 of accounts receivable, approximately $5,680 are going to be uncollectible. Okay, so now, all right, question I may ask you, all right, at this point, what is the net realizable value? Okay, just as an aside, if I asked you at the end of December, what is the net realizable value of the accounts receivable after I make this adjusting journal entry? What would your answer be? What would you say? What is the net realizable value? Very good, guys. 94,320. Very good. 94,320. Excellent. And what did you do? You took $100,000, which is the balance in the accounts receivable, and you subtracted out the amount of the allowance account that was established. Okay, very good. All right. So now, what do we know? We're using the balance sheet methodology, okay? What do we know? We know that we want to end up in our, the balance in our allowance account of $5,680. Okay? So what do we have to do? We have to look at what the existing balance is, okay? We have to look at what the existing balance is in the allowance account, okay, before the adjusting journal entry. All right, so stick with me. This is the part that gets a little tricky, okay? So what I want you to realize at this point is that the balance sheet methodology, okay, the balance sheet methodology for estimating bad debt, okay, always considers the existing balance in the allowance account. Okay, again, 2 points on an exam. The balance sheet methodology always considers the existing balance in the allowance account before the adjusting entry. Okay, always consider what the existing balance is before the adjusting entry. Okay, so let's walk through this. At December 31st, Valley Ranch has a total accounts receivable, as we just saw, okay, as a total accounts receivable at the end of this month for $100,000, okay, of which 5,680 are estimated to be uncollectible, okay, again, at the end of this month. So what are they going to have to do at the end of this month, December? They have to record an adjusting journal entry. And what do they have to do? They have to replenish the allowance account for the current month's sales, okay? Or for the current month's level of accounts receivables, okay? So again, thus an adjusting journal entry is needed to increase the allowance for doubtful accounts from whatever its present level is to 5,680. So whatever the opening balance is in that allowance account, we want to make sure that at the end of the month, okay, after adjusting journal entry, we want to end up with a balance of 5,680. Okay, we're replenishing that account. So what I suggest you do, okay, when you're using the balance sheet methodology, always do write down the T account or the general ledger, allowance for doubtful accounts. Okay, so here, what information are we given? Okay, what information are we given here? We're told here that there is a credit balance at the end of this month of $4,000. Okay, and you won't make a mistake if you write it down like this. We know we want to end up, okay, so we have, before the adjusting journal entry, we have a credit balance of $4,000. What else do we know? We know that at the end of this month, we want to have sitting in that contra asset account, okay? We want to have an ending balance of $5,680, right? What's the only way we're going to be able to increase, okay, our balance from a $4,000 balance to $5,680? We know we have to further credit this account for $1,680. Okay, remember what I said here. Okay, the balance sheet method. Remember, balance sheet method, those are permanent accounts, right, that appear on the balance sheet. So the balance sheet method always takes into account what the balance was in this contra asset account before the journal entry, before the adjusting entry. So here, once we do this analysis of where we are and where we want to get to, What is that journal entry now at the end of the month? We are going to debit the uncollectible account expense for $1,680. Okay, and then what else are we going to then credit? We're going to credit the allowance for doubtful accounts for $1,680. Okay, and that's what has to happen, okay, with the balance sheet methodology. All right, any questions? Okay, now, okay, so stick with me. Okay, now I'm going to give you a second situation. Okay, so here, let's say, all right, that before the adjusting journal entry, okay, before the adjusting journal entry, the allowance for doubtful accounts, all right, let's say that it had $1,000, but it had $1,000 debit balance. My question is, can that ever happen? Can it ever be that the allowance for doubtful accounts before the adjusting journal entry has a debit balance? Do you think that could ever happen? Daniel, you think no? Denise, no? Anybody else? Okay, remember, not if they pay it, but if what happens? If, okay, this can happen, you can have a debit, okay, allowance for doubtful accounts, if what? If basically the previous month's bad debt, okay, if the previous month's allowance for bad debt it's too low. Okay, if I underestimated the amount of bad debt expense for my previous month, okay, if it's too low, what happens? I could end up with a debit balance in my allowance for doubtful accounts. Because remember, I set up that allowance, okay, I set up that contra account, okay, for all the potential customers that may call me. That may call me and say they can't pay me. Okay, so what happens? Remember, when a customer calls me and tells me in the following month they can't pay me, what's the journal entry? Remember that allowance for bad debt is going to be debited when I get that dreaded phone call. The allowance for bad debt is going to be debited. Okay, when I get that call from the customer, and then what account is going to be credited? Accounts receivable. Okay, because once I know the actual customer, accounts receivable is going to be credited. Okay, so here, all right, if I underestimated my bad debt expense for the current, for the previous month, what can happen? I can end up with a temporary balance in my allowance for doubtful accounts of $1,000. Okay, is that clear? Okay, so if my estimate is too low, I'm going to end up with I could end up with a debit balance. Does that make sense, everybody? Because of this journal entry here. Okay, so now question: if, all right, if at the before my adjusting journal entry for this month, okay, if I have a debit balance, okay, in my allowance for doubtful accounts of $1,000, but what do I know I want to end up with? I know that I want to end up with a credit balance, right? Okay, because a review of this month's accounts receivable says that I want to end up with a credit balance of $5,680. Okay, my end point is still the same. It's just the fact that here I have a debit balance. Okay, so in this instance, okay, what would be the adjusting journal entry? What would be the amount that I would debit to my my uncollectible account expense at the end of this month? Anyone? I have to reverse this debit of $1,000, and I have to replenish the account for $5,680. Okay, so what is the amount that's going to be credited to the allowance for doubtful accounts? Anyone? Yes, very good, Shamia. Ding, 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 ding. Very good. 6,600, very good, and 80. All right, so that's why I'm telling you, whenever you use the balance sheet method, when you're determining how much you want to replenish that allowance account for at the end of every month, always use the general ledger accounts. Okay, so what would the adjusting journal entry be in this instance? I would debit my uncollectible accounts expense for $6,680, and I would credit my allowance for doubtful accounts by that $6,680 for this month. Okay? And again, look at the difference here is that the balance, okay, remember what I said here, using the balance sheet methodology, you always have to consider what the existing balance is in that allowance for doubtful accounts. Okay, so here, since we had an existing credit balance before the adjusting journal entry, okay, of $4,000, I only had to replenish that account for $1,680. Okay, so that was the adjusting journal entry here. However, if I had a debit balance in this allowance account, okay, before the adjusting journal entry, and again, that's because of the fact I underestimated the amount of my uncollectible accounts for this month. If I wanted to, I had a debit balance for $1,000. I want to end up with a credit balance of $5,680. What am I going to have to do? I'm going to have to credit the allowance for doubtful accounts for the $6,680. Okay, so again, using general ledger format is always going to help you here. Okay, is that clear? Is everybody good with this? Okay, and remember, how often are we going to do analysis? How often do we do the aging of the accounts? Typically, very good. It's going to be on a monthly basis. Very good. Okay, because remember, the accounts receivable changes on a monthly basis. All right, so again, always consider what the existing balance is under the balance sheet method. All right. All right, so. All right, now we're going to go to the second methodology, okay? And again, a corporation can pick whatever methodology they want, okay? Just like, you know, in terms of which depreciation method they want, which inventory method they want to. The same thing is for selecting an approach for aging or for estimating your bad debt expense. Okay, the second approach is the income statement approach. And again, it's one or the other, okay? And a corporation has to apply it consistently, okay? An alternative approach, okay, for estimating and recording credit losses is the income statement approach. And it makes sense. This one focuses on an income statement account, okay? This one, okay, this methodology is the easier methodology, but it's considered less accurate. Okay, and I'll show you why in a moment. Okay, this method focuses on the uncollectible account expense. And what are you going to do? You're just going to look at the amount of net credit sales. That's the number that you're going to look at, okay, on the income statement, net credit sales. Okay, and you're going to try to figure out, okay, based on past experience, okay, what amount of those net credit sales are going to ultimately be uncollectible? Again, so you're setting up, you're estimating the amount of bad debts, okay, on a monthly basis. Here, instead of looking at accounts receivable, a balance sheet account, you're looking at an income statement account, which is net credit sales. Again, on an okay, I'm going to tell you what the total net sales were. Okay, I'm going to try to trick you, and I'm going to give you what the total net sales were. And I'm also going to tell you what the net credit sales were. Okay, remember that certain amounts of the net sales are cash sales. Okay, your cash sales are not going to be possibly uncollectible. Why? Because the customer paid you at that time. Okay, you're not looking at the net sales for the month. You're looking at the net credit sales. Okay? Those are the only ones that could possibly end up being uncollectible. Okay, so here again, the credit manager, on the basis of past experience, tries to come up with a percentage, okay, based on past history, some percentage of net credit sales that ends up being uncollectible. Okay, and again, the journal entry for a net credit sale, okay, whenever in life you're in doubt, always look at the journal entry. Remember, when you're recording a credit sale, the debit is always going to be to the account receivable. Okay, and the credit is to credit sales or sales revenue. All right, you're only interested in the sales revenue for those sales that are not cash, that are not received in cash. You're looking at the net credit sales related to accounts receivable. And again, you would have to, the nice thing about this chapter is you really have to be provided all the information. You just have to know how to apply it. Okay, so here, if we're using the income statement approach, okay, the adjusting entry, okay, is always just going to be made, okay, you're going to take what the credit sales were for the current period times the percentage of net credit sales estimated to be uncollectible. All right, so the nice about the income statement approach, why it's easier, is that the income statement approach does not consider, the existing balance in the allowance account. Okay. What you're going to do when you use the income statement method, you don't have to worry like you did when we did the balance sheet approach. Whatever the balance is in that allowance for doubtful accounts, that's the balance that we're going to start with. And then we're just going to change the balance based on a percentage, okay, that we've established or the credit manager has established, times the amount of credit sales for the period. Okay, so look how much easier this methodology is. Okay, so here, let's say that a company's past experience says, and you'd have to be given this, okay? Remember, you can't figure it out on your own. Okay, based on past experience, you're told that about 2% of the credit sales, not total sales, of credit sales will prove to be uncollectible. If credit sales for the current month end up being $150,000, what's the adjusting journal entry for uncollectible account expense at the end of this month? Look how easy. All you have to do for the income statement methodology is just take the credit sales figure for the month, 150,000, multiply it by the amount of credit sales typically that are uncollectible, which equals $3,000, and look how nice and easy. Income statement method, all you have to do is replenish the accounts based on the current month's credit sales and the probability of being uncollectible. So all you have to do is debit uncollectible account expense for $3,000, credit the allowance for doubtful accounts, $3,000. Okay, that's what makes it so easy. Again, all right, so just here, if you're looking at the balance, the allowance for doubtful accounts, okay, the allowance account, if using the income statement methodology, you had a balance of $2,000, okay, a credit balance at month end before you did the adjusting journal entry, if you had a credit balance of $2,000, what would be the journal entry amount? Okay. All you would do here using the income statement, you would just have to increase it by $3,000. So what's the ending balance then at the end of the month for your allowance account? $5,000. Okay, very good. You're always just going to ignore, okay? You don't care what the existing balance is. You're just going to increase it by the current month's calculation. Okay, let's take an example that we had earlier. Okay, if we're looking at the allowance account, okay, and basically our analysis says that based on the amount of sales, of credit sales for this month, okay, we are going to credit this account for $3,000. Okay, that's what we see in the journal entry here. Even if you had a debit balance in this account for $500, it doesn't matter. That balance is not going to be used in your calculations. You're still going to do the same journal entry that you have here. Okay, and what's the ending balance then in your allowance account going to be? $2,500. Okay, doesn't matter. Again, what's the consistent thing here? Okay, when you're using the income statement methodology, you're just increasing the allowance account based on the percentage of bad debt expense times the amount of the credit sales for the current period. Okay. Of course, on an exam, which methodology do you hope for? You hope that you have the income statement method. Okay, but all right, can anybody tell me why is it that the balance sheet methodology is considered more accurate? Again, GAAP accepts that you set up your estimate using the income statement approach, but what about the balance sheet approach makes it more accurate? That's why typically it's the one that's more often used in the annual financial statements. Anyone? What did we do in our calculation when we used the balance sheet methodology? Okay, so very good, Shamia. Excellent. We looked at what the, they both really do, Rachel, because they look at tendencies. Because here we're estimating it around, we're estimating the amount of bad debt. Okay, so here, again, absolutely the balance sheet method looked at the previous balance. Okay, what else? Anybody else? What did we do here? They're both updated monthly. Okay, what did we do here? Remember that, and again, write this in your notes. Using the balance sheet methodology, remember we aged the account. We did an aging of the accounts. Okay, and remember the example I told you, what happens the longer, if you lend your friend money, what's the likelihood of non-payment the longer that that debt is outstanding? Again, the probability that the debt is not going to be collected increases over time. And again, since the balance sheet method does an aging of the accounts to see how long it's actually been outstanding, okay, it is considered the more accurate methodology. Okay, because the age, remember, when we did the, when we used the income statement methodology, we just took that flat percentage of bad debt expense, okay, that we estimated, times the amount of credit sales. It was just that flat. And we also did not consider the existing balance. When we use the balance sheet method, because of the fact that there's an actual aging, okay, and we look at how long the accounts receivable have been outstanding, okay, that's considered the more accurate. Okay, so the balance sheet method is considered the more accurate method. Cough, cough, right? Let me see that again. Is the more accurate method. For estimating bad debt. Okay, so the balance sheet method is considered more accurate for estimating bad debt because of an aging of the accounts receivable. Okay, and Shamia, so why would a corporation use, usually, typically, Shamia, excellent question, usually because the fact that the way they maintain their records, okay, it's not as easy for them to determine what the aging of their accounts receivable are. Okay, it's usually the smaller corporations. And in fact, excellent question, Shamia, what a lot of corporations do is what they'll do is that over the year, okay, they'll estimate, okay, the amount of their bad debt expense using the income statement methodology, okay, and then at year end, they'll use the balance sheet methodology to come up with what their balance in the allowance account is at the end of the year, okay? That's acceptable too, okay, but it's just because it's consistent. Okay, and usually it's just the way that the information is maintained in their general ledger system. Okay, here you have to know the amount of your accounts receivable. You have to know how long they've been outstanding. You have to have a credit manager who's familiar with estimating the amount that's ultimately going to be uncollectible. Okay, so those, again, tend to be smaller corporations, maybe don't have as sophisticated a general ledger system where they could just get this information easily. Okay, but again, GAAP doesn't care. Okay, they will allow you to use either methodology. Okay, you're welcome. All right, so again, accounts receivable, estimating allowance for bad debt expense, two different methodologies. Okay, you have to be familiar with both. Okay, and again, don't be nervous because you know that it's always going to be, the information is given. Okay, for the balance sheet, the aging of the accounts, for the income statement methodology, though, remember it's a percentage of credit sales, not a percentage of total sales. Okay, that's a key. Under pressure, don't make that mistake. Okay, now, okay, what can happen? Okay, occasionally what happens is that a customer calls you and says, you know what, we have an account receivable with you, and we're not going to be able to pay you. Okay, you basically extended credit to our company, but we can't pay you. We run into some cash shortages, and we believe we're going to end up going out of business. Okay, so remember that. Okay, when you had a, so remember that when you, excuse me, when a customer calls you, the actual customer calls you and tells you, I can't pay you the amount of the account receivable that I owe you. Remember, when you get that call, the dreaded phone call, the journal entry is always going to be, you're going to debit the allowance to doubtful accounts. You're going to reverse out the amount that was, now you know it's no longer doubtful. You know this person can't pay you. Okay, so when they call you, you debit the allowance for doubtful accounts, and you're going to credit the accounts receivable. Okay, when you get that dreaded phone call. Again, what does that do? It reduces the allowance account. Okay, and it's also going to reduce the account receivable. You can't leave that account receivable on your balance sheet, otherwise you would be overstating your assets. Okay. Now, all right, what can also happen? Again, because this is, again, as you mentioned, Rachel, it's a human tendency. Remember, the corporation that has the bad debt, okay, that says, I can't pay you, they want to stay in business. If, for some reason, you get a phone call now from this, from a customer, Brad Wilson, and originally he told you, I can't pay you, write off the amount of my bad debt. Okay, what can happen is Brad Wilson now calls you and says, you know what, I was able to get a line of credit. Okay, I want to pay off the amount that I owe you. Again, that does happen in business. Somebody who at first told you, I can't pay you this amount that you basically sold me. you write off their account receivable. It's not unheard of that they will call you maybe a little later and say, oh, you know what, I can pay you. Okay, and why would they do that? Why do you think that a corporation, if they're able to pay you, if they get a loan of the cash, okay, or if they get a sudden windfall, why would they call you back and say, oh, you know what, I could pay you the amount I owe you? Why would it be in their best interest to do it? It's exactly, Joshua. They want to maintain the relationship. They want to do business with you in the future. You're never going to do business with them if they don't pay you, right? Their credit rating is also going to be affected. So they want to reestablish that. So when you get the happy phone call from your customer who was a deadbeat before and said, I can't pay you, when you get the happy phone call and they say, or they are now able to pay you, remember, you wrote off their account receivable. Okay, so the first thing you have to do is now debit their accounts receivable, reestablishing that account receivable, and credit the allowance for doubtful accounts. You're going to put that money back into the allowance for doubtful accounts because they're telling you now, I'm actually going to be able to pay you. Okay, so it's no longer a bad debt. You have to replenish that account. Okay, and then this journal entry down here is wrong. Please just reduce this. What's the journal entry? Okay, for those of you, you're all now sophisticated accountants. What's the last journal entry then you're going to make? After they call you, they tell you, I can pay you. You're going to debit their accounts receivable, credit the allowance for doubtful accounts. What's the second journal entry? Ask when you're going to do. Again, think logically. What is the customer? Excellent, Kristen. You're going to then debit the cash account. Very good. Okay, for $500. And then you're going to credit the accounts receivable for the $500. Very good. Okay. Again, so when the customer is trying to reestablish their credit, you debit their accounts receivable. Okay. You're going to credit the allowance for doubtful accounts. You're replenishing that account. And then you're going to debit your cash account when you get the cash from them and credit the accounts receivable. Reestablishing the credit and paying you off is going to require 2 journal entries. Okay. Good. Okay. Very good. So let's go. All right. So now we've gone over all this detail as to how you basically estimate the amount of your bad debt expense. Again, on your books and records, if you have a significant amount of credit sales, you have to establish this allowance account. Okay, you know that life always has to be complicated. What's the complication here? Okay, the IRS does not accept. Okay, the Internal Revenue Service, when you're filing your tax returns, the IRS does not accept the allowance methodologies. Okay. The Internal Revenue Service, the IRS says, you know what, I don't care how much you think is going to be uncollectible. You're only able to write off the actual amount of debt, okay, that you actually are aware is going to be uncollectible. Okay, and again, so there's 2. So what happens here when you use when you're filing your taxes, you must use a different methodology. For tax purposes, you have to use the write-off methodology. And the direct write-off methodology basically states you can't recognize any bad debt until you get the call from your customer. Okay, only when you get the call from your customer or a letter from your customer saying, I can't pay you, right? That's the only time you can then prepare this journal entry. When Bell Products calls you and says, I can't pay you, that's when you're going to debit the uncollectible account expense, credit the account receivable. Okay, so under the direct write-off method, okay, there are no estimates made. Okay, no estimate of bad debt expense for tax purposes. Okay, and again, so what does that mean? Okay, That basically means you have to have a financial system in place or a general ledger in place that is able to get this information, okay, that is able to draw this information down on which customers actually called you and said, I can't pay you, all right, for tax purposes. Again, IRS is not interested in people, in your estimates. They just want the facts, okay, the facts of who called you, said they can't pay you. That's the only deduction you could take for bad debt, okay, on your income taxes. Okay, who else might be able to use the direct write-off method? Basically, if you have a very nominal, if you have a very low amount of credit sales, like an all-cash business, they might be able to use the direct write-off method for their financial statements as well. Okay, so if for tax purposes, or if you have a very low amount of credit sales, very low credit sales, those are the only times that you are able to use the direct write-off method for bad debt. Okay, if your credit sales are very low or for tax purposes. Okay. And again, if you use the direct write-off method, you're not trying to estimate any of the bad debt expense. Okay, all you're doing is you're just recording bad debt when your customer tells you that they are not going to be able to pay you. All right, so two differences really. Okay, so again, you have the two methodologies for estimating bad debt. GAAP requires that you estimate bad debt either using the balance sheet method or the income statement method. Okay, however, for tax purposes, or if you have a very low cash dollar amount for credit sales, then you could use just the direct write-off method. Okay, and again, that only recognizes a customer's bad debt when they call you and tell you, I can't pay you. Okay, no estimates are made. All right, so you can see how accounting for a large corporation is very complicated. Okay, remember this, going back to your baby accounting, right? When you first started taking one-on-one accounting, 3 different types of accounting information, okay? But remember, those 3 different types of accounting information, financial accounting information, management accounting information, and tax accounting information, all are being generated from the same software, from that same general ledger system. Okay, but you have to be able to manipulate that information to come up with all the different reporting requirements. Okay, so you can imagine for complicated financial structures, that's going to be difficult. Okay, but it must be done. That's why accountants, a corporate publicly traded corporation has thousands of accountants working for them. Okay, because all that financial information has to be reported according to whatever guidelines, tax guidelines, GAAP, whatever guidelines they must follow. Okay, so GAAP requires estimates. IRS, though, for estimates for bad debt, IRS does not allow you to estimate. Okay, you have to only use a direct write-off. Again, the direct write-off method doesn't use any estimates. Again, the allowance method is preferable because, again, what does the allowance method do? Remember, it follows the matching principle, right? That's why we went through that whole thing. Why GAAP requires you to estimate bad debt, because you're matching revenues and expenses during the same time period, okay? When the revenues are generated, that's when you're recognizing that there's bad debt that is associated with those revenues as well, okay? However, okay, current income tax regulations require that only the direct write-off methodology is going to be used, okay, in collecting the amount of uncollectible accounts expense. Again, they think, okay, there's a little manipulation in there. No, they just want the facts. The IRS only the direct write-off when you've been notified. Again, it's always better to match in accounting theory. You're sophisticated accountants now. It's always better to try to match the revenues and expenses incurred in that same time period. And that's why most companies use the allowance method, except if they just do if they're a cash business. Okay, and the amount of their credit sales is actually very nominal or very low. Okay. All right, the last thing I want to go over for this chapter, just in terms of before we go over the homework, okay, there are some, remember, you're sophisticated accountants now, so there are two ratios that you have to be familiar with, and again, they appear in the homework assignments as well. All right, again, what are we looking at in this chapter? We're looking at primarily the accounts receivable that appear on your balance sheet. Okay, and we're trying to estimate how much of those accounts receivable are ultimately going to end up being non-collectible. Okay, so, and again, what else do we want to know? You know that accounts receivable are the lifeblood, okay, of a corporation. Accounts receivable are a very important current asset, right? Again, they're so close to cash, but they're not quite cash yet, right? So one of the ratios that you're going to look at, if you're a potential creditor, if you're a potential investor, okay, or a supplier, okay, what, again, before you sell any goods to a company on credit, what are you going to look at? You're going to look at their accounts receivable turnover ratio. Okay, the accounts receivable turnover ratio, all right? And basically, what does this mean? Okay, what does it stand? What does it measure? It basically measures how many times the company's cash investments were turned into cash. Okay, and again, another way of looking at it is on average, okay, again, on average, how many times a year does the corporation complete its operating cycle? Okay, how many times over the course of the year does the corporation complete its operating cycle? Okay, so do you think the corporation wants this number to be high or low? Okay, remember the operating cycle starts with cash. The corporation purchases inventory. They sell that inventory on credit. Okay, so do they want their ratio to be high? Exactly. The higher, the better. Exactly. So how are you going to calculate that ratio? You're going to take the annual net sales. And again, which financial statement is that going to come from? Annual net sales. Okay, that's going to come from the income statement, right? Annual net sales. And what are you going to do? You are going to divide. Okay, what are you going to do? You're going to divide by the average accounts receivable. Okay, so the average, the annual net sales divided by the average accounts receivable. So let's say that for this particular year, okay, you're going to take them, this corporation has $1 million in net sales. Okay, Okay, and then it's average accounts receivable. And remember, that's taking the beginning balance of the accounts receivable and the ending balance in accounts receivable and dividing by 2. The average accounts receivable equals $25,000. Okay. All right. So what does this mean? Okay, if you're doing an analysis for this particular company, it means that they turn over their accounts receivable. Their turnover ratio is 40, or they turn over their accounts receivable approximately times a year. Okay. So again, is that good or is that bad? Okay. Again, you can't tell from that number alone. Okay, because it's always relative as to what type of inventory are they selling. Or are they selling expensive inventory, inexpensive inventory? What's the turnover ratio for that industry in total? Okay, so the second part, after you figure out what the accounts receivable turnover ratio is, the next number, which is a little bit more understandable, is now you're going to be able to figure out the number of average days the accounts receivable is outstanding. Okay, so the average number of days accounts receivable is outstanding. Again, typically does a corporation want that to be high or want it to be low? The number of days the account receivable is outstanding. Remember the aging schedule we just went over? Yes, they want it to be low. Okay, because again, they don't want it out. They don't want to float their customers for long periods of time. So the accounts receivable turnover ratio, the numerator is always going to be the number of days in a year, which here is, which is for us always is 365 days. Okay, then what are you going to divide by here? You are now going to divide by the accounts receivable turnover ratio, which equals 40. Okay, so what does that mean? The 365 days in a year divided by the 40 accounts receivable turnover ratio tells us that approximately it takes 9 days on average for this company to collect an account receivable. Okay, and you can see how when you this number and you put it in this particular contract, how that's more of a meaningful number. Okay, 365 divided by 40. Okay, that tells you the average days, okay, that it takes this company to collect on an accounts receivable. Okay, again, most companies want to decrease the number of days an account receivable is outstanding. In this instance, it would be 9 days. Okay, but for this particular company, using this specific example, it seems like their average days to collect is pretty good. Okay, so they wouldn't require maybe as much additional work on collecting their accounts receivable. They have a good collection turnover. Okay, so you can see here, when you use ratios, you really understand. If you're a creditor and you're going to lend money to this company, if you're an investor and you want to invest in this company, if you're a supplier and you're going to extend credit to this company, okay, something that you're really interested in, how long does it take them to collect the money from their customers? Okay, so these are 2 really important ratios, okay, to look at. Right, when you're looking at a company's finances. Okay. All right. I think we're good for today. Okay, so we'll stop just about 5 minutes early, just so you can all run and vote. Okay, please, everybody, stay healthy, stay happy. When we meet next time, we are going to start with the homework for Chapter 7. Okay. Start with the homework for Chapter 7, and then we're going to start with our next chapter, which is Chapter 16. Okay, now we are going to, we're now looking at management accounting and management accounting reports. You are leaving financial accounting after this chapter. Okay, So everybody stay healthy, stay happy, stay safe. All right, have a wonderful weekend. Please study. You know when your next midterm and next final are. I'm sorry, next midterm and next quiz. All right, so keep up with your work. We have, a little bit over a month left. All right, so stick with it. Okay, and have a good day. Thank you, guys. Keep working hard. Thank you, guys.